Welcome back to RD360, where I'm chatting with Nirmal Jain of India Infoline and Vidhun Desai of Morgan Stanley. Phil Fisher, one of the greats, Warren Buffett calls someone who's influenced him in his thinking. A most famous quote, let me read that out to you. It says, "The stock market is filled with individuals who know the price of everything but the value of nothing." Explain that to me, Vidhun.
I think that's one of the most eloquent things said about the markets, which is that a lot of people who participate in the markets, and I use the word participate because not everybody is an investor, do not differentiate between price and value. Value is something that is the worth of a stock.
The intrinsic value.
Yeah, that's very different from the price. The price is essentially, if I were to explain it in technical terms, is the culmination of everybody's view on the value. But the value to you may be different than the value to somebody else. The reason why these differences arise is because I have a different view about the future. I may be more optimistic, so the value of that thing may be more to me, whereas somebody else may be pessimistic and the value may be less. And the average of the two values becomes the price.
Right.
So that is the difference between price and value, and investors, when they are investing, have to keep judging this against what they think the value is. They may be right or wrong. You need to use all the tools at your disposal, and experience counts as well. And then once you have judged that value, then you compare it to the price, and if the price is lower than the value, that's a stock that you want to own, or that's
buy.
Yeah, that's a investment instrument you want to own.
Right.
It's not just stocks; it's for anything that you may want to own, and otherwise you want to actually not own it.
But let me tell you a story about the '92 bull market, which explains this maxim to me. When this bull market started in 1989, cement was in the leadership, and people had a lot of disrespect for cement at that time. I know ACC for the last 40 years traded between 100 rupees and 400 rupees. So there's never condescension. ACC doesn't go anywhere. It's stuck in the range for 40 years. But what people didn't factor in was that decontrol had come into cement, and instead of making 2 rupees per bag of cement, they were making now 20 rupees per bag of cement. So there's a whole new profit figure that ACC enjoyed. So someone who looked at the last 40 years and said ACC doesn't go anywhere didn't understand the value of cement in a decontrolled economy.
Yeah.
And people who did saw the price go from 400 to 10,000,
yes,
as you well know. Nirmal, can you share an example of that with us?
Well, there are several examples. You look at Jindal Steel and Power in 2004. I mean, equivalent to split, the stock was at 15 rupees. Today the stock is 700 rupees. So stock valuation was less than $500 million. And they had coal mines, iron ore mines of their own, and they were planning power, captive power. So if you look at the value of the company, it was significantly higher, but still people ignored it for liquidity reasons or for perceptions about sectors or whatever.
Or management.
Or management. The stock multiplied by 6 times in 4 years, then another 7 times in 2 years thereafter, that is during the last 2 years. So if you look at last 5-6 years, the stock has given you a return of almost 40 times. Or you look at pharma stocks just 2-3 years ago, because people think that okay, they are not low beta stocks, nothing exciting is happening, they can't give you 60-70% return. But what they ignore, that this 25-30% return is almost risk free and is resilient to economic cycles, is resilient to recessions and whatever happens in the advanced developed world. And look at the stock like Lupin or Dr. Reddy or Sun Pharma, they have given exceptional returns, or even Cadila for that matter. So I think this is the most fundamental of stock markets, because the buyer thinks the value is more than the price, and the seller thinks that the value is less than the price, otherwise the transactions won't take place. And we'll know whoever is smarter makes money, and if your call on value is right, then you'll end up as a winner. Like look at real estate market today. The prices have gone through the roof, and everybody knows that this is not the right value, but one doesn't know when the value will, when there will be regression to the mean and the value will again come to the fore.
But just to take you up on the example you said of real estate, let's talk real estate circa 2011, that the prices of real estate are still at highs, whether you're talking Bombay or in any other markets, but the market capitalizations are dwarfed. So now is there a disconnect between price and value? I mean, the value of the real estate is very significant, but the market cap does not reflect that fully. Would you say that's fair, Nirmal?
I think it's very interesting, and we must know how to value a company which is different from the assets or the sector as such. Because when you value a company, it is not only the business that it is in, it also takes into account the management, the perceptions about management and also the underlying factors. Because look at most of the real estate companies, they have huge leverage. So there is a high risk that you take. If you're buying a real estate with your own money, is different. But you're buying a play on real estate which is leveraged by itself, can be very risky, because as we are discussing that the value might be lower than the price, and then if there's a fall in the value in the price, then all these companies will have a leverage hit on them, one. Secondly, most of them have very complicated structures, so it's not that they own real estate in one company, they lend in some 150 subsidiaries. Also, the management has a track record, and most of the times we have seen that
It's not that obvious, you're saying.
it's not that obvious.
What is obvious to you? Is there any sector that's that obvious to you?
Yeah, no, well, there's one more point I'll add here, is that investors should not forget that value is a function of expected return.
Of course.
So if my expected return is higher, then the value of everything will be actually much lower to me than somebody else whose expected return is lower. So that value is a huge function of expected return, and expected return actually moves over cycles. So it tends to fall during exuberant times. That's why exuberance gets created, because the prices of everything goes up, because everybody imagines that the value has gone up because I'm now anticipating a lower return. And the reason people anticipate lower and higher returns is a function of their psychology.
Nidam, I have many